I want to discuss the cost of equity. Now, the cost of equity is important because we need it to be able to value a stock. We also need it in our cost of capital calculations when we're doing capital budgeting. Now, estimating the cost of equity is difficult because unlike debt, cash flows aren't fixed and the time horizon is infinite. When you buy a bond, you'll have a fixed coupon and there will be some set maturity date, for example, 15 years or 30 years. So valuing debt's relatively easy. So in order to find the cost of equity, we need to make some assumptions. So the first approach we can take is to assume a perpetuity. That is, dividends will remain constant forever. In this case, the pricing equation is going to be the price equals the fixed dividend divided by the cost of equity, which we're denoting by K sub E. If we solve for the cost of equity, we get the cost of equity equals debt divided by the price. Now, this may seem rather naive, but in the case of preferred stock, it tends, in many cases, to pay a fixed dividend. So if you know the dividend, you just divide by the current price, you get the cost of preferred. Let's take a look at a simple example. If the dividend will be $4 forever and the current stock price is 40, the cost of equity is 4 divided by 40, or 0.10 or 10%. The second approach we can take is to assume perpetual growth. This is known as the Gordon growth model. Here we assume that dividends will grow at this constant rate of G, and we're going to assume that the cost of equity is greater than the growth rate of dividends. And the reason we have to do that is that if G is growing faster than or is larger than the cost of equity, you get sort of a nonsensical answer. If you look at the pricing equation, the price today equals the dividend divided by the cost of equity minus the growth rate of dividends. If G were greater than the cost of equity, you'd have a negative number in the denominator and you'd get a negative stock price, which doesn't really make any sense. So if we solve for the cost of equity, K sub E, we get that it equals the dividend next period divided by the price, the current price, plus the growth rate of dividends. D1 over P0 is what we refer to as the dividend yield. G turns out to be the capital gains yield. If you're buying a stock, there are two parts to your return. The return you get from the dividend, and then the return you get from buying your stock at a certain price and selling it for a higher or a lower price in the future. That would be your dividend, or I'm sorry, that would be your capital gains yield. Okay, if it went up, okay, you could have a loss as well. So let's take a look at an example. Smith & Jones have just paid a dividend of $4. The current price of the stock is $40. Dividends are expected to grow at a 3% rate per year forever. So let's find the required return. The dividend that's given is D0, so you'll need to find D1. Dividend next period is just going to be the future value of D0, so it's just going to be D0 times 1 plus the growth rate. So it's $4 times 1.03, or $4.12. So here it's $4.12 for the divided by 40, that's our dividend yield, plus 0.03, and we get 0.133, or 13.3%. So keep in mind, if you're taking an exam or doing homework, you have to read the question carefully. If they say they just paid a dividend of $4, that's the current dividend, and you have to find the future value, that's D0. If they tell you the dividend is expected to be $4 a year from now, they're giving you D1 and you should not be adjusting it. Okay, the final approach we'll take here is to use the security market line. This is a model that relates the return that stockholders get to the risk-free rate and the risk they're taking times a risk premium. So here, the cost of equity equals the risk-free rate plus beta times the market risk premium. The market risk premium being the expected return of the market minus the risk-free rate. Usually we use as our market return the return on the S&P 500. Beta is a measure of volatility. It tells us how much our stock's price fluctuates relative to the market. A beta equal to 1 would mean that the volatility is very similar to the market. That is, when the market goes up by 1%, you would expect your stock to go up by 1%. If the market goes down by 1%, you would expect your stock to go down by 1%. If the beta is greater than 1, then you expect to go up faster when the market goes up, but go down faster when the market goes down, more volatility. If beta is less than 1, the stock tends to be less volatile than the market. The market goes up, it doesn't go up as fast, the stock. If the market goes down, it doesn't go down as fast. So things like utilities tend to have fairly low betas, right? If the economy's booming, people aren't going to be using that much more electricity. Perhaps industry will use a little bit more. If the economy is not doing so well, people are still going to need to heat their homes. So again, they can't cut back all that much. So things don't change all that much. Now, beta you can calculate by running a regression of the returns of your stock against the returns of some market index like the S&P 500, or you can just look it up. Okay, these are reported all over the place, like Yahoo Finance, to name one. Let's take a look at a simple example. So let's assume that a company has a beta of 1.25, so it's more volatile than the market. The risk-free rate is 5%, and the market risk premium is 8%. So what we're going to have is the cost of equity is going to be the risk-free rate of 5% plus 1.25 times 8%. Make sure you do the math in the correct order. You have to do the multiplication first. So here we get 15%. If you're interested and you want to work backwards, in this example, the return on the market needs to be 13%. Right? If the risk premium is 8% and the risk-free rate is 5%, then the return on the market is 13%. Right? That's how we get the risk premium, 13% minus 5%. So in this case, the expected return is 15%. So this is how you value these. You may use the growth model, the dividend growth model, and this security market line and average the two. People will do different things. Sometimes you will adjust it. Okay, that doesn't have so much theoretical background to it to say our cost of equity is going to be, 5% more than, whatever our bond yield is. But the Gordon growth model, as well as the security market line or capital asset pricing model, are the two most common ways for calculating these. And I hope you found this useful, and thanks for watching.